Welcome to Showcase Broadcast Studios and welcome to Showcase Live. My name is Michael Wardy, Certified Financial Planner and Regional Director at Source Advisors. And thank you to those at YouTube and LinkedIn and Twitter for joining us today. And a special thank you to Rollin Groseclose, a shareholder and partner at Johnson Price Sprinkle, CPA firm in Asheville, North Carolina. Welcome.
Thank you. It's good to be here.
Absolutely. Rollin, I want to give you the opportunity because today's conversation is all about a very hot topic. I would say the PPP and what is new about it. We're going to get into that. Before we dig in, I want to give you a chance to really introduce yourself and your firm, especially because you guys have, from clients that I've talked to and businesses I've talked to throughout North Carolina, we've seen where there's been a lot of education that you guys have brought to the table. So as leaders and at the forefront of what's going on with PPP, I wanted to at least share where the expertise is coming from.
Great, thank you. I appreciate that. Yeah, again, Rollin, we work with APS. We're a firm based in Western North Carolina in the mountains. And our focus is really on small to mid-sized, closely held, family-owned businesses. And, that's in many respects the driving force of the economy in the U.S. And so we've really focused our efforts there, focus a lot of our efforts on tax and tax compliance, as well as financial statement, a lot of the traditional accounting services that you might expect. But we're also always looking out for what's affecting our clients. What's impacting them? What's causing them to ask questions or deal with issues? And is there an overlap kind of in the financial world that we operate in where we could speak into that? So, once we had the CARES Act come out back in March and kind of a response to all of this that was going on with the pandemic, we just felt like, it was important to get news and information out to our clients. Personally, I like the technical, kind of difficult, challenging stuff, but I'm a processor. I've got to kind of think through it, figure it out, and understand it myself. So we try to use that same approach in translating it for our clients, right? Taking challenging, difficult, hard to understand topics and kind of breaking it down. And so we represent a variety of industries, a variety of businesses, from hospitality to manufacturers and distribution. Just runs the gamut of types of businesses we work with. And I'm just thrilled to be able to provide some information and help on this broadcast today. So thank you.
Perfect. Thank you, Rollin. And for those out there, YouTube, Twitter, and LinkedIn, if you do have questions, go ahead and post those, and we will do our best to get to those questions. If we can't get to them for any reason, Rollin and/or I will follow up with you and get those questions answered. So, Rollin, to get started. And I do want to admit this. I did reach out to some people and ask them to attend, but they weren't able to. But they did send me some questions that they wanted to ask you. So I do have questions for you.
Great.
But just to get started, tell us a little bit about the PPP, the second round, or I know when we were talking earlier, you said for some it's the first round versus the second round. Can you give it just a background of what it is that we're looking at now?
Yeah, so PPP, it always helps. The acronyms are great, but it always helps to kind of go back to what that acronym is for. It's Paycheck Protection Program. So I think keeping that in mind, paycheck protection, that's a key element of the program. And it's basically a forgivable loan made by the federal government through the SBA. And it has the potential of being 100% forgiven. So unlike most loans that you got to start making payments at some point, it's entirely possible and actually likely that loan will be forgiven and that there won't have to be any payments, no interest, no principal, nothing. It's just basically a grant or a gift, if you will. And I would say for small to mid-sized companies, this is probably the most widely used and popular of the stimulus provisions that have come out to date in this pandemic arena. So basically, you've got the series of formulas and an application process. You've got to apply for the loan through a qualified lender, the majority of those being banks, but there are also some community lenders that provide these SBA loans. You go through those, the process gets moved along through to the SBA. funding happens, and then you've got some requirements about how you can spend the money to ultimately get forgiveness on the back end.
Got it. And so if someone didn't take it before, either they missed it, they couldn't get to it. There was a whole lot of challenges when this first rolled out. I'm sure you know this better than I do. There were a lot of challenges in getting this accepted, finding a lender, all that. If they weren't able to get to it before, can they still take it, or flip that around? If they already took it once, can they take it again? Can they apply for it again?
Yes and yes. So we get it get it both ways. Yeah. So the program started the money started flowing in early April. They quickly ran out of money just because demand was really high. They brought some more legislation and funded it again, and then pretty well early August they closed the doors. Funds had been used up, and they said, okay, that's it. And then with this last round of legislation that came in at the end of 2020, they funded it again and placed some additional restrictions. But so yeah, if you didn't participate the first time around, maybe some of the scrutiny that was in the media about making sure that you're actually eligible, or maybe exhausted other means. There was a lot of different opinions floating around about whether or not it was okay to go ahead and take this federal money that would be forgiven. Some people just shied away and said, no, I don't want it. I don't want to risk it. Or maybe things just progressed and got worse later on, and it was too late and you couldn't get it. So yes, you're eligible, subject to the criteria, to go back the first time around and get it. If you're going to the well kind of the first time, the primary condition, I would say, is you have to feel like there's some economic uncertainty with regards to your business. Uncertainty about the future, uncertainty about how COVID is going to continue to impact your company, those sorts of things. That's one of the key representations that you have to make. Otherwise, the program fundamentally in terms of the application hasn't really changed. Maybe you even repaid some of the money the first time around, decided you didn't need it all, or just repaid it all. We had, for example, some clients that got some, and then all the media stuff hit and said, maybe we don't want to, and they repaid it. But you really did need it. And so you can actually go back now under that provision and either get the rest that you didn't get, or just go and do a first round loan and get that. Then on the second draw, what we're calling a second draw loan, you're going back to the well a second time. They've tightened up the restrictions a little bit, so it's a narrower population that they're trying to target with this additional funding. And the main thing there is that you have to have had a decline in your revenues by 25% or more. So your revenues have to be off, and you can look at this over the course of 2020 compared to 2019, or you can look at it for any given quarter. So if any given quarter, second, third, fourth quarter of 2020, compared to that same quarter in 2019, if you're off by 25% or more, then you're eligible to go back and get one of these loans.
You would qualify. So does that tie in when you mentioned about the economic uncertainty? So you look at a quarter compared to a quarter from either 19 or 20, and then you say, okay, we still are seeing a projection of economic uncertainty. So yes, we should apply for this and we would qualify based on that. Is that what you're referring to? Or is it just an industry, our industry has economic uncertainty, and so we're going to apply? Or is it both?
Yeah, so it's kind of both. The consideration of economic uncertainty is kind of a basic premise to this program. There are other programs out there, but they intended this money to be for the businesses that are, especially the second draw loan, for businesses that are really struggling and continuing to have economic uncertainty. If this is your first time going out, they just want to establish that you do have reason to believe that there's a question mark about what things are going to look like. Of course, that's always there, right, with the future. We really don't know the future. But if you've been running the business for 10, 15 years and it's been steady Eddie and even growing, that doesn't mean that you don't qualify. The pandemic must have surfaced some unknowns, some questions for you. And that's basically a kind of a continued representation that you're making.
Okay. And when you go through the process, I know last time there was a lot of challenges. Is it comparable? Are you foreseeing that's going to be comparable to what the challenges were last time, where people were scrambling? I know that we had one company that contacted me to find a lender. They're in New York. I found somebody, I think it was in Texas or Louisiana, and I connected the two because they couldn't find a bank in New York to do it. Do you see that being the same challenge, or is it a smoother process?
I think the process this time around is going to be smoother. For one, everybody that participated the first time around is familiar with the program on the lending side. So finding those banks and lenders, they've already been through it. They knew what that was about, and they've likely already decided we're going to do it again or not. A few of them have said, we're not going to do the second round. But for the most part, they are already familiar with the process. SBA worked out the kinks. The banks figured out how the SBA is going to work. And so we're expecting the process this next time around to be a good bit smoother. In fact, we've already had some clients apply for a second draw loan pretty quickly after their bank told them that it was open, because I think the SBA opened it up a week and a half to 2 weeks ago. And the banks came around pretty quickly, and we've already seen some say, hey, we're ready. And those have already been processed and passed along to SBA, and we're waiting for an answer.
So it's already open, but I don't feel like there's been a lot of broadcasting and announcing it. And I mean, I haven't heard a lot of people scrambling to grab it up like they did the first time. Are you seeing that as well?
Yeah, I guess I haven't seen as much promotion from banks and lenders. And it could be that, they're reaching out to their previous customers and say, hey, we're here again, maybe privately instead of a broad broadcast, because I would expect the number of applicants the second time around are mostly in that second draw bucket. They're not going to the well the first time. This is their second loan. That's my expectation anyway. I don't know that I have much to base that on other than, a lot of people got that loan the first time around. Yeah. So I think it's probably just that maybe people have kind of figured it out, lenders have figured it out, and maybe there's more direct reach outs to their customer base.
Got it. And so I know on the first round, or I shouldn't say I know, I heard on the first round, it was pretty restrictive on what it can be used for. Is that the same case? Of what can the money be used for now?
Yeah, so this last legislation basically piggybacked everything from the first round in terms of what the money can be used for, but it also expanded it and added some additional categories. So again, paycheck protection, the main one has to be payroll. So at least 60% of the money, in order to secure forgiveness, at least 60% has to be for payroll. Beyond that, on the non-payroll side, that other 40%, just like the first time around, it can be for rents. Those rents had to be in place, basically at the beginning of 2020. So they don't want you to write a new lease agreement with yourself and try to start counting that money and get forgiveness, right? They want a pre-existing, pre-COVID rent agreement in place. So you can use that. Pre-COVID utilities. So if you were under contract for electrical and water and gas and those sorts of things, that counts. A pre-COVID mortgage obligation, the interest on that mortgage can count. And then they added some new categories, and those are one, under payroll. Payroll is not strictly compensation, so it always included retirement that the employer pays for. It also included healthcare that the employer paid for, but they expanded, or at least clarified, what healthcare means, which is not only traditional health insurance, but also a group term life, group disability, group vision, and group dental. So I think some practitioners had already kind of made the assumption that group dental, group vision might have already been included, but they basically clarified and said those are all part of healthcare costs and part of payroll costs. So that's some expansion there, which is helpful.
So wait a minute, I'm going to take a side step on that statement. So 401k matching, employers been matching it for however long. They can continue and use the PPP for 401k matching.
Yep, and get forgiveness basically because they're continuing a practice. Or maybe we even heard from some that because of uncertainty they turned it off and stopped matching, and then maybe the thing stabilized some and they turned matching back on. That matching, if it's in that for that PPP loan and during that period of time that it covers, then they could count those employer matches as well.
Well, and that's what I was going to ask you. If they were matching, let's say, I know a lot of employers do 6%. And if they were matching 6% and then they had the influx from the PPP, they could increase it while the PPP money is there and then drop it back down? Or is that just not right?
Potentially, there's definitely some areas to be careful and watchful there, and there's a good bit of guidance out there. I mean, obviously, the spirit of the law is to help maintain. It's that protection side of it, the paycheck protection. They're trying to secure, keep people employed, and really, it's an alternate to the unemployment lines. They'd like employers to help keep people working rather than burdening the states with the whole unemployment process. And so, while that could be, there are some aspects of catch up. Maybe you were forced to or felt forced to reduce compensation by 10%. And now you've got a little kind of this extra help from the government via PPP. Can you restore compensation? And yes, you can. You can kind of restore compensation to what it normally was using these funds.
Okay. And then, so last time you had to go through the process to get the full forgiveness. Is that changing? Has that changed?
So it's the process hasn't changed a whole lot except for the smallest loans, and by the smallest I mean $150,000. That's a threshold that SBA established and the legislation established. That for those smaller loans, they're kind of gonna expedite the process. For example, if your loan was that size or smaller, you can submit a forgiveness application and basically say, yes, I've met all the criteria, and not even have to provide documentation. All of the documentation, or at least, but you do have to have it ready. You have to have it available because they could come ask for that. Or at the time of the application, it's a shorter form for those smaller loans. There's not as much involved, not as much that you have to report. So other than that, it's really going to be the same process, at least at what we know at this point. Okay.
And so from what everybody's learned from the first one to the second one, what guidance or advice can you share to help people out? Because I know that they're still going to have questions. I'm sure there are the businesses that will do this on their own, and hopefully will do it correctly. But there's going to be pitfalls, and there's going to be hurdles that they have to get over that they didn't know. So to prevent that, are there specific things that you would say, here's what you need to watch out for?
Yeah, just thinking back, a few things that come to mind. One is, I would say generally get all you can the first time around. So going back a second time to try to get more that you should have gotten is a little bit more of a process. You got to kind of be able to probably document some more things along the way. So do your homework and make sure you're counting everything. For the loan amount is based on payroll. So it's a multiple of payroll, 2.5 times, or I might talk a little bit in a minute about a group that gets 3.5 times average payroll. It's 2.5. Let me say it this way: it's 2.5 months worth of average payroll for a base period, which is usually in 2019. So 2.5 months worth of your average payroll, that's what the loan amount is. Could be 3.5 times. So you want to make sure that you've got a good payroll number there that you're counting, your payroll costs. And then, but that doesn't mean that you can't spend it on these other things. So some people feel like, well, when I applied, all I said I was going to use it for was payroll. And so now I can't use it for rent and mortgage and these other things that qualify. And that's not true. You still can count and use it for all these other expenses. The other thing that I think we saw a number of questions and challenges around is, the more categories of expenses that you claim, the more documentation you do need to come up with. So we saw a lot of people look at just payroll. Say, I don't want to mess with these others. I can get it all with payroll. And I would say the majority of times that was the case because we had a 24-week period over which they could spend the money.
Yeah.
And that 24 weeks for most everybody was enough to fully expend it solely on payroll. Then that winds up being the easier one to claim and not bother with the rest. Yeah. But if you're close or you're unsure or it's really tight, one, use the full 24-week period if you need to, and then count all those other costs. Just include them just in case there's some question or some issue and some of it gets excluded for some reason. You've still submitted plenty to get full forgiveness.
Got it. Okay, that's great. Since we still have time, I want to ask you about other credits. And even if you could touch on the ERTC or the ERC, just to give everybody an understanding of what else is out there and what else is going on. I think that would be helpful.
Yeah, so I'm going to back up just a minute and talk just a second more about the PPP,
Yes.
because there is some overlap with these other credits as well.
Okay.
So PPP, obviously, it's intended to be a forgivable loan. It's basically like a grant or a subsidy, if you will, coming from the government. So when it comes to some of these other credits that are payroll tax credits, the rule of thumb is you can't double dip. You can't count the wages for PPP and get forgiveness, and then turn around and count those same wages and get these tax credits. That's just kind of a fundamental rule, and just generally speaking, I think just common sense that they're not going to allow you to get it both ways.
Fair.
And so, yeah, there are two other credits I wanted to mention, and I'm going to maybe try to speak just a little bit to some misconceptions about these, because we've had a number of clients and other businesses reach out. Or we've reached out to them and said, well, I didn't apply because of XYZ. And we're like, that doesn't matter. That doesn't really come into play. And
Sure.
we go and chase it down with them, and turns out, well, there was $25,000. There's $100,000. We had some with a couple $100,000 that they left on the table thinking, well, I can't do anything about that. And turns out they qualify. So the first one, and maybe the easier of the two, is what I call COVID sick pay or leave pay credits.
Okay.
So these are where an employee is subject to quarantine. Either they've been told to quarantine because of exposure, or they've had symptoms and they're waiting on a medical diagnosis. The leave pay side of it comes into play with maybe they have somebody in their household, a child or a family member, something like that, that is subject to those restrictions. So they have to care for them, or they have to be available to help them. Or, schools being closed, or daycare facilities being closed, or a daycare provider, even an individual that's unavailable because of COVID, a COVID quarantine and so forth. That's what these payroll tax credits are for. So employers up through December 31st were required to pay employees for this sick or leave pay. And it was generally up to 80 hours worth of pay. And they couldn't reduce their normal PTO or vacation time or sick time. They couldn't force them to use those other things. They had to pay them. And because of that requirement, the government said, we will reimburse you via payroll tax credits 100% of those wages. Well, sometimes I've talked to some clients and they thought this was just a deferral. This was just, kicking the can down the road. You're going to have to pay it back later. That's not the case. These are fully refundable tax credits that you don't have to repay. The other thing we've heard is that we thought this was just for the taxes on those wages. It's not just for the taxes. It's the actual wages themselves. So if, let's say I came down with COVID and I was out for 2 weeks, 80 hours worth, and I couldn't come in and I couldn't telework, I couldn't do anything else. And my employer has to pay me for those 80 hours. And let's say that's $5,000. I don't even know if that makes sense, but let's just say it's $5,000 for simple math. The payroll tax credit available is $5,000. And so my employer, JPS, would basically file or withhold $5,000 of the taxes that they need to pay into the IRS, their federal tax deposit. They would keep that back and just keep it in their bank account because they had to pay me COVID pay. And so it's kind of an upfront, real time, if you will, credit. And then that's all kind of proven out and reconciled on the quarterly 941 payroll tax reports. But that's a substantial number.
Is there documentation? I'm sure there's got to be some type of documentation or something from a medical professional saying this person was not able to work for this period of time, or is it just they couldn't work?
Yes, so there does need to be documentation. There needs to be communication, from the employee. There can be documentation from the doctor, and I guess, there's all kinds of rules there about what an employee can be required to provide, those sorts of things. But there's good guidance on the IRS website about that. But there's some basic documentation to say, hey, I was, my doctor said XYZ, I need to quarantine, that sort of thing. So there is some documentation. It doesn't have to be sent in. It just needs to be on record. The employer just needs to have that in their files in case the IRS comes knocking and asks for support.
Right. And
so one thing related to that, I'll mention, those wages are not subject to the Social Security employer match. So that's another thing that we found employers are missing. They're taking the credit on the wages, but they're still paying Social Security tax on those wages. Well, those are exempt. It's kind of a function of the credit, but basically you don't have to pay that 6.2% match on those COVID wages. And you also get to count an allocable share of healthcare costs. So if you're, that person's out for 2 weeks, you're continuing to pay their health insurance, you get to count 2 weeks worth of health insurance towards that credit and also get effectively reimbursed for that time for those costs as well. So it's a big deal.
Have you seen where people actually know this? I've never heard of this. And we talk with business owners all the time, and that's never been brought up. Do people know about that?
So it's kind of a mixed bag. A lot of our clients do, because we've sent out some e-blasts on it. Then I'll just, I'll put a little plug in there. Any one of you welcome to check out our website. I think on our homepage, there's a headlines link, and there's a news tab there. And if you'll scroll down to the March, April timeframe, that's when you'll see information about these start to roll out. And so yeah, we found that some know about this, but again, there were a lot of misconceptions, and then some of them didn't know about that. Found a new controller, a new bookkeeper on the job somewhere along the way, and the ball got dropped, or the predecessor never communicated it, or they're new to the role, a whole variety of things. So we've tasked, like, all of our team members, hey, go back when you're talking to clients as part of the year end, just double check. If you can't tell, if you didn't talk to them, just ask again. Doesn't hurt to ask a second time. We don't want folks leaving money on the table.
That's the truth. All right, Rollin, we have a question that just popped up. I want to throw it on the screen. It's from Pat. Do you think the second round will be forgiven?
Yes, I do. The language essentially piggybacked the first CARES Act language, and there were some additional clarifications and so forth, but they didn't even bother to rewrite those provisions. Instead, what they did is they basically said, this is a continuation of the CARES Act provisions. And so if you spend the money the way you're supposed to, within the time period that you're supposed to, the 60% on payroll costs, up to 24 weeks, if you spend the money as you're supposed to and you submit that application, you should be eligible for forgiveness just like you were the first time around. Yep.
Great. Thank you, Rollin. Thank you for that question, Pat. All right, so Rollin, let's get back to some of the other credits that you've seen. Are there any others that we're missing that we haven't touched on?
Yeah, so one other significant one is the employee retention credit. This has certainly the potential to be a lot larger than the COVID sick and leave pay credit. And but it also has probably more limited application, limited number of employers that can get this. I think the first thing to make sure and let everybody know is that the first time around that the employee retention credit came out with the CARES Act, as did the PPP loan program. But under the CARES Act, if you got a PPP loan, you couldn't claim the ERC, the employee retention credit. You just one or the other, pick and choose. Right. And since the PPP was restricted to smaller employers, 500 or less the first time around, 500 employees or less, most of the time, small businesses went and got the PPP and didn't bother with the ERC, the employee retention credit. And so but there was no size restriction on the employee retention credit. So what we saw is a lot of very large employers going after that credit, and none of the smaller ones because they got a PPP. And we too, because we generally represent the small to mid-sized employers, didn't bother even digging into the ERC very much. It just wasn't worthwhile for most of our clients. This latest legislation, the Appropriations Act signed at the end of December, actually opened it up and said, never mind that. If you got a PPP, you can also get the ERC. You can get both. And they also made it retroactive. So there are a few nuances still with that credit that the IRS needs to come out and clarify how we do this. But because it's retroactive and it was also extended through 2021, we kind of need to make a distinction between the rules that apply to 2020 and the rules that apply to 21. So I'll just run that through that real quickly. For 2020, you had to be subject. There are two criteria. The first one is you had to either be subject to partial or full shutdown. A perfect example is a restaurant. either forced to close or forced to limited capacity, 30% or 50% occupancy, those sorts of things. That is a partial shutdown or potentially a full shutdown if you weren't able to do catering or takeout or other things.
Sure.
So that's a partial shutdown. That would make you eligible, period. So hotels, bed and breakfast, restaurant, those fitness centers, all of those are clearly candidates for the employee retention credit in 2020. The second criteria is if you don't meet that first one, is you had to have a decline in revenues by at least over 50%. That's obviously a big number. Your revenues had to be off by more than 50% compared to the same period in 2019. So you can look at year over year. Yeah, okay. You can look at year over year, or you can look at quarter over quarter. They'll let you kind of do it either way.
Got it.
But it's a big reduction. You have to be way off in your revenues. But it's a credit in 2020 of up to $5,000 per employee. So if you got 10 employees, that's potentially $50,000. And you can get there to that maximum number pretty quickly. Once you're in the door, once you're eligible, those numbers accumulate really quickly. So that's a big advantage.
Yeah.
Looking into 2021, just a couple of distinctions is that instead of that, the same shutdown criteria is available. So if you were subject to shutdown, that's still one condition for you that can help. Mm-hmm. If you don't have that, though, the revenue reduction, instead of over 50%, it just needs to be over 20%. So if you're operating at, say, 75% of revenues, again, compared to 2019, they want to look at a pre-COVID period, 2019. If first and second quarter of 2021 is less than 80% of what it was back in 2019, then you're eligible for the credit. And the credit's been sweetened. It's now up to $7,000 per employee per quarter. So with 2 quarters, that's up to $14,000 per employee for 2021. So it's easier to get it, and the credit's a lot higher. So I think that's a big credit with some big dollars on it. Not everybody will benefit, but probably a lot can.
Yeah.
Sorry, Michael, I seem to have lost you. Michael, you still there?
Oh yeah. Wow. That's a lot of good news. That's a lot of good information. Rollin, you there?
I am here. Not sure what happened there. Sorry about that.
So no, that was my fault, and I apologize. And I apologize to everybody. I think with the snow that came through Chicago, we had a little bit of a glitch and a pause in our broadcast. But I'm back up. We're back up. Great. So I'm glad that happened towards the end. But Rollin, I do sincerely apologize for that glitch on this. But this is a lot of great information. And with all this information, of course, there's going to be a lot more questions. So if out there, YouTube, LinkedIn, Twitter, if you have additional questions, Rollin's information is below there. Email him at rollin@jpspa.com. Give him a call, 828-254-2374. There's a lot of great information on their website as well, jpspa.com. Rollin, thank you again for joining.
You're
This was
welcome.
great information, and it's very timely considering we're at the beginning of the year, trying to get our arms around everything. And I think because we're heading in the right direction with getting the vaccinations and getting all the stores and offices and restaurants and everything opened up again, these type of conversations and this information helps people move in the right direction as well.
Right. So great. I appreciate you having me, and I'm happy to share this information.
Absolutely. Absolutely. Thank you, everyone. Stay healthy, stay safe, and Happy New Year. I know we're at the end of January, but I'm still stuck in that Happy New Year. Be well and enjoy. I will have this recording posted on LinkedIn, YouTube, and Twitter so that you can watch this again and reference it at any point in the future. Thank you. Enjoy, Rollin.